In October of 2021, we saw the first Bitcoin ETF hit the stock market, and this caused the Bitcoin price to boom. We saw Bitcoin hit a new record high at the time of right around $65,000 per coin. Right after the first Bitcoin ETF hit the market, we saw the second Bitcoin ETF hit the market the next week, and that helped continue this Bitcoin rally. You can see that there was a lot of excitement behind these Bitcoin future ETFs because as soon as the first ETF hit the market, BITO, this was created by a company called ProShares. As soon as it hit the market, it hit $1 billion worth of assets under management, which means you saw $1 billion enter this ETF. That was the fastest ETF to hit $1 billion in assets under management in history. And that's exciting for a lot of cryptocurrency investors because this was an ETF that was a derivative of Bitcoin, so cryptocurrency. To put it in perspective, the ETF that held that title before this Bitcoin ETF was the GLD Gold ETF, and this was set back in 2004 when it took 3 days for the Gold ETF to hit $1 billion in assets under management. Now, there's a couple things that are worth noting about these ETFs and what's going on around it, because a lot of cryptocurrency people and Bitcoin people are very excited about it because it shows that, okay, the SEC approved this ETF, so we're starting to see more adoption of this Bitcoin or cryptocurrency world, which is great. And now you have people being able to invest into cryptocurrencies and Bitcoin through Wall Street, which means that you're going to see more buyers come into Bitcoin, you're going to see more buyers come into cryptocurrency, which is going to help cryptocurrency prices go to the moon. Yeah, well, it's true that these ETFs help drive more publicity and more validation towards Bitcoin and cryptocurrency, and now you have these big asset managers buying these Bitcoin ETFs. You have to understand that this is a derivative of Bitcoin. It's not actually Bitcoin. See, BITO is not an actual Bitcoin ETF, it's a Bitcoin futures ETF. When you go out and you invest in an ETF that gives you exposure to the S&P 500, now this ETF is actually owning shares of these companies in the S&P 500. So when you own an ETF, you're essentially owning shares of the companies indirectly because the ETF that you're investing in invests and owns those shares. This Bitcoin ETF does not own any Bitcoin. It is a Bitcoin futures ETF, meaning it is a derivative, kind of a derivative, because what it's doing is it's allowing you to invest and get exposure to Bitcoin by not actually owning any Bitcoin. Futures contracts are very popular in the commodities industry because it is a way for you to hedge your risk. So let's say that you need a whole bunch of gas to fill up your trucks or your planes or whatever it is. You need gas to do that, and you sell tickets for people to ride onto airplanes. Well, it can be risky to sell tickets for next month if you don't know what gas prices are going to be next month. So what you can do is you can buy a futures contract where you buy a predetermined amount of oil at a predetermined price. You're buying it at a future price because you don't know what the price of oil is going to be. With Bitcoin and this Bitcoin futures contract, you're not actually buying Bitcoin in the future, you're just investing in this ETF, which is giving you exposure to Bitcoin's price in the future when you could actually just go and buy Bitcoin by using a cryptocurrency exchange. If this ETF actually owned Bitcoin, it would be a derivative of Bitcoin. But it doesn't. It invests in futures contracts, and you don't get any Bitcoin at the end of it. So you're not investing in a derivative of Bitcoin, you're investing in a derivative of Bitcoin. Now at this point you might be wondering, what the heck does all this mean, Jaspreet? All I know is that this ETF is bringing more publicity and more PR to Bitcoin and is legitimizing Bitcoin and cryptocurrency because now you have Wall Street pouring their money into assets that give exposure to Bitcoin. I like to look at history, and history doesn't repeat itself, but it does rhyme. And if you remember before the 2008 crash, what caused the 2008 real estate crash to be so much bigger than it could have been if it was just contained in the real estate market? It was because banks started creating derivatives and more derivatives and derivatives upon derivatives of this mortgage market. And then they started selling these investments and more money started going in. So now people were not betting on the actual housing market, they were betting on derivatives and derivatives of the housing market. And so this created a house of cards in the housing market. Now I get it, cryptocurrency and the housing market are two completely different things. I get it that this is not the exact same as that. But what I'm trying to say is anytime we start to see more and more derivatives created upon an asset where you can very easily go and buy the asset, because it's not that hard for somebody to go out and buy Bitcoin. Just go and open an account with BlockFi or Coinbase or Gemini. You can create an account, buy some Bitcoin. It only takes a few minutes. But the whole idea behind the ETF is it is supposed to give people access even easier to get exposure to Bitcoin. But they're not actually getting exposure to Bitcoin. You're getting a derivative of a derivative of that, which makes it risky. Now, I know, I'm just a random guy on YouTube, which is why you need to make sure you do your own due diligence and never blindly listen to a random guy on YouTube, but I own actual Bitcoin. I don't own the ETF, but this is where you got to be a little bit cautious and be a little bit wary, because anytime you start to see all these derivatives of derivatives coming on, now you start to build a bigger house of cards, because people don't just want to own the asset, they're just trying to get rich off of the asset without actually owning the asset. Look, now that we have the first Bitcoin ETF on the market, it has opened the floodgates for companies trying to capitalize on this by creating and opening more Bitcoin and cryptocurrency ETFs, and some of them are risky. The Wall Street Journal put out a piece titled "The SEC Will Not Approve Leveraged Bitcoin Funds Yet." With the subtitle, "The regulator has signaled it will only allow unleveraged funds tied to the cryptocurrency, at least for now." As soon as you saw the first Bitcoin ETF hit the market, you saw companies going to the SEC saying, hey, let us create a Bitcoin ETF too, but we want to do something a little bit different. We want to do it with leverage. We want to allow people to double up their bets or triple over their bets by allowing us to invest in Bitcoin with a whole bunch of leverage. So if Bitcoin goes up, people will be able to make even more money. Not just the 10% that they see it rise, but by 25% or 50%, because we want to use leverage to invest in these assets, and we will be able to make even more money for our investors. And the SEC said no. It says that Valkyrie Investments proposed to launch a new fund that sought to amplify the daily returns of a portfolio of Bitcoin derivatives, including futures contracts and options, by using 1.5 times leverage or borrowed money. And then that very same day, you had a different company go to the SEC, and they said that they wanted to create an ETF that allows you, investors, to now bet against the Bitcoin futures contracts used by ProShares, so the BITO ETF. So this is where things get a little bit tricky, because yeah, it's cool. You're starting to see these cryptocurrency ETFs hit the market, which start to give you a little bit of validation, because it shows you that Wall Street wants to put their money into cryptocurrency. But what's interesting is they can actually use their money to buy the actual asset. They can use their money to buy Bitcoin or any other cryptocurrency just as easily as it would be for them to go out and buy the ETF. But the reason why these ETFs can be a little bit risky is because now they're derivatives. Not just direct derivatives, but derivatives upon derivatives. And now you have a whole share of companies that are trying to create these highly leveraged ETFs, which right now they're not allowed to. We don't know if that's going to stay that way or not, but they're trying to create these highly leveraged ETFs, which will allow you to not just invest your money in a derivative of a derivative, but now to up your bets by allowing these companies to use high amounts of debt. That way they can increase your profits if it makes money, which also means if it loses money, you lose even more money. And then you have companies like I just mentioned trying to create ETFs which let you bet against the whole thing. This is where I want you to be financially educated. That way you can proceed with caution and make sure you're investing in the right things. Know what you're investing in. If you're investing in these ETFs, know what you're actually getting, and understand that, hey, we are having volatility, and hey, there are more risks coming anytime you see more derivatives upon derivatives, because now you have a whole bunch of money flowing into building this house of cards that is reliant on this one asset class, which can make things a little bit scarier. So you just want to be smart and understand what it is that you want to invest in, and you want to understand that, hey, if you're investing for the long term, you want to be a long-term investor, and that doesn't mean that you're going to see things go straight up like this. You can see things go down like this, back up like this, so you just got to be a little bit smart. The second thing that you want to pay attention to has to do with MasterCard, the credit card company, who says that now they want to start incorporating cryptocurrency. CNBC explains it very well, because MasterCard said that they want any bank or any merchant on their network to offer cryptocurrency services, and that means that you can have thousands of banks and millions of merchants on their payment networks to now integrate cryptocurrency into their products. That means you can potentially pay for things with your Bitcoin wallet if you can sync it with MasterCard. That also means that you could potentially get paid with cash back, not in cash, but now Bitcoin. This is what a lot of people have been waiting for, the adoption effect of cryptocurrency, which would allow people to actually make transactions with cryptocurrency like Bitcoin. Like Bitcoin is supposed to be used as a currency, which means you're supposed to be able to use it to buy and sell things, but it's hard when the person you're trying to buy something from doesn't allow you to pay for it with cryptocurrency. If you go to Walmart today and you try to check out, they're going to require you to pay with cash or your credit card. And right now, your credit card probably doesn't sync with Bitcoin. But now, if this changes, that means now not only can you pay with cash or your credit card, you might be able to pay with Bitcoin through one of your credit cards. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. These are things that you can start doing even if you don't have a lot of money. So if you want to read this free guide on how to start generating passive income for free, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.